Markets pulling back from records today, but our next guest expects U.S. stocks to outperform the rest of the world in the new year. Morgan Stanley Private Wealth's Katerina Simonetti joins us here on set. She's the firm's private wealth advisor. Katerina, great to see you.
Thank you for having me on the show.
So you're pretty optimistic of 2026, but within the notes, I do see that you are concerned about tech's vulnerability. How does what happened today, the questions around Oracle, the questions around Broadcom, inform that?
Absolutely. I would say the best way of putting it is we're cautiously optimistic.
Okay.
There is no way to hide the excitement behind technology, right? The AI, generative AI is changing the world, changing the way we do things. But we have to proceed cautiously. When you look at the world of AI, the focus in 2025 was the buildup. How do we get there? Building infrastructure, building data centers, getting us there. But now the question is, how do we actually use it? How do we implement it? And how do we get profitability out of it? And it's that show me the money moment that is going to be whether it works or not in 2026. That's our focus.
Right. At the same time, there is a bullish narrative on the street about 2026, and it feels like it's consensus at this point that there's going to be Fed rate cuts. You see 3, for instance, in 2026, that tax refunds are going to be big. There's going to be changes to tax policy that will benefit consumers and businesses. Everybody believes that. What makes you, are you worried that everybody believes that at this point?
Whenever there is that momentum, right, that we're all either so optimistic about something or pessimistic about something, we have to ask ourselves, what are we missing? And we think that the big elephant in the room are tariffs, right? Like we talked about tariffs and then we stopped talking about them. Like they're a little bit less impactful. But the truth is, maybe it takes time to integrate the tariff, the results of the tariff policy into the economy. It is really the economy plus labor that is going to direct the Fed decision. And if Fed is going to end up not cutting rates as many times as we'll expect, that's going to be a surprise, right? And with overvalued stocks, specifically in the tech sectors, as we're talking about tech, and we see the results right now, we see that heightened level of volatility and sensitivity. They are the favorite stocks for our investors, but they're also the ones that scare them the most. And so it adds that emotional component to the investing.
So, Katerina, what are you doing for your clients to hedge against that in case you're wrong, right? Because you always have to have a plan B. Or what are you investing in, or what are you investing as a peripheral to it? Is it small caps, or is it another technology?
We advocate broadening of the investment process. One is we're huge proponents of profit taking. When something is up, we absolutely don't advocate changing the strategy, but taking a little bit of money off the table, investing in some of the sectors when maybe we're not overrepresented, is always a good idea. Plus, we love thinking of tech as something that drives the markets. But when we look at the last couple of years, let's look at the industrials. Let's look at financials. Let's look at this exceptional performance in the sector. So we advocate profit taking, broadening of the market, taking advantage of the international opportunities where valuations are not quite as high as here in the U.S., and also, just taking the tax losses.
Right.
This is just, we have to do it in a tax-efficient way.